Hey everyone, in this video I wanted to do a breakdown of two beaten down growth stocks and answer which one of these two stocks is the best one to buy. Now I've had a chance to go through and evaluate each of these latest earnings reports from Disney stock and Peloton stock, and after evaluating those earnings results, I can now make a conclusion which one of these two stocks is the best one to buy now. So that's what I'll do in this brief video. So let's begin. Starting with Disney, who saw its revenue increase by 13% in the quarter, with earnings per share rising to 69 cents, almost triple the 26 cents in the same quarter the prior year. Of course, Disney is still recovering from the devastations of the pandemic. It's still not yet back to full strength. It's got several more quarters to go before it reaches that level. Think about it. Disney has theme parks internationally and a few in China, and China's economy just recently reopened. So that's going to be a boost, a tailwind to Disney over the next several quarters. However, Disney's streaming segment is slowing down after growing to nearly 200 million subscribers. It shed 4 million subscribers, Disney Plus did, down to 157.8 million in the most recent quarter. Of course, that's after Disney raised prices by several dollars per month. Now, the biggest downside to Disney right now is the linear segment, cable connections. People have been canceling cable and satellite connections and choosing streaming subscriptions instead. Disney generates a significant amount of profits from its cable channels, and so that transition has been up and down for Disney while they capture, some of the people that cancel cable end up signing up with Disney on one of its or many of its streaming channels. It's just the transition is not smooth and it's causing disruption in its business. For that reason, investors have been down on Disney stock over the last several quarters, and it's down significantly off its highs. Moving to Peloton, which saw its revenue decrease by 22% in the most recent quarter, down to 749 million. However, its net loss on the bottom line improved to 276 million. That was from a loss of 757 million in the same quarter the prior year. Peloton is also recovering, but from a different reason. During the pandemic, Peloton's business absolutely thrived. Sales surged, and the previous management team decided that it was smart to make huge investments to ramp up capacity. They purchased a manufacturing company and they spent money adding their own manufacturing facility. All of those investments in growth are now weighing down the company because when economies reopened and gyms reopened, demand for Peloton's equipment decreased. And so the timing was terrible. And now Peloton is recovering from that. The previous CEO resigned, and there's a new management team in place now. And the new CEO, I would say, is doing a good job in right sizing the business, although there is room to go. The good news for Peloton is that the connected fitness subscriptions increased to 3.1 million. That was up from 2.96 million in the same quarter the prior year. So when you buy one of Peloton's exercise equipment, it comes with a monthly subscription that you have to pay for, nearly $50 per month. That's a very high profit margin business. Look up here, subscription gross profit margin at 68% in the most recent quarter. So even though the purchases of new equipment have slowed down, the people that already had Peloton's equipment have still been paying for the subscription, and that's a very high profit margin business. So what Peloton has needed to do, and the new CEO has been doing, is just lowering its operating expenses so that it can generate profit margins from the subscription business while incrementally adding new subscriptions by selling new equipment at a more modest rate. But if your business expenses are lower, a more modest rate of sales of new equipment won't hurt as badly as when you've expanded tremendously. So that's what this new CEO is doing, and I would say has done a really good job so far in bringing the business into balance. So all that being said, let's look at their valuations, comparing the Walt Disney Company and Peloton on the forward price to sales ratio. Looking at this metric, Disney stock is roughly twice as expensive as Peloton stock, trading at a forward price to sales of 1.793 compared to the forward price to sales of 0.891 for Peloton stock. Still, even though Disney stock is more expensive, if I had to pick one of these two growth stocks to buy right now, I would buy Disney stock. I like Disney's prospects longer term. I like the theme park segment. It's incredibly profitable. And ultimately, I believe the transition from cable to streaming will be a positive for Disney as it'll lead to people consuming the content more. So if I had to pick right now, I would pick Disney stock. But that's all I've got for this video. Thank you so much for watching. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.